Campbell Soup is down 26% year to date, right there at the 52-week low with a forward yield of 3.6%. Is this a buy now? Are we looking at a super undervalued price for the company at the 52-week low with a starting yield that we like to see towards the high single digits, 8-9% yield on cost over the next few years? Now, today's episode, we are going to take a look at the historical performance of the company. We're going to jump into their income statements, look at their top line revenue growth year on year, as well as dipping into that bottom line net income to see how the company has performed over the last 5 to 10 years. And as always, we're going to take a look at the balance sheet, look at the health check, how the total cash and short-term investments compares to the total debt of the company. And this will in turn take us to that dividend safety and some very important financial metrics for Campbell Soup Company. And as always, we're going to look at our stock valuation model, getting to our intrinsic value with our acceptable buy price given our margin of safety. Now, it is down 26% year to date, and it is towards that 52-week low. Now, shareholders who have held the company over the last 10 years would have essentially seen their investment at negative 1% return without that yield reinvested. So what we want to understand is today the perfect time to enter into this price, which looks to be undervalued right there at that 52-week low, with a yield for the long term into the high single digits, moving into the double digits. Now, in terms of the company itself and that income statement, what we typically like to see is that top line 3 to 7% growth year on year. July 2019, they reported 8.1 billion on the top line. July 2023, so their most recent annual report from a few weeks ago, 9.4 billion. So it has increased over the last 5 years, and we will look shortly at the 10-year growth percentage-wise. But what we can see, if we take a more granular level, we can see that whilst it increased from 2019 to 2020, it did then drop in 2021, and then it picked up again to 2023. So it seems fairly inconsistent at that top line. And not only that, when we do take a look at their bottom line, their net income, we can see a similar approach there. So their bottom line, 211 million, was reported as net income in 2019. Latest annual report, 858 million. So again, whilst we do see that increase on the bottom line over the last 5 years, what we can see in actual fact is that it has increased to 2020, but then all the way to 2022, we see that drop consistent year on year on the bottom line, and then it does pick up slightly in 2023. So it is a fairly inconsistent business so far based on the income statement. Now, what does the balance sheet tell us? How is the health of the balance sheet? Well, they had 31 million in cash and short-term investments in 2019, and their latest quarterly report showing 189 million. So they have had an increase in cash over the last 5 years. But how does that compare to the total debt as well as the direction of that movement? Now, when we take a look on the balance sheet at their total debt, we can actually see 8.5 billion in July 2019. But very positive to see they have in fact nearly half that total debt to 4.7 billion. So not only have they increased their cash, as we can see up here again as a reminder, they've also decreased quite significantly that total debt, which is a very positive sign. Now, what this is going to lead us into is that dividend safety. So straight away, we see a dividend safety score of 60, making it borderline safe, with a market cap of around 12 billion, making it a large cap company. Now, some key metrics, more for those that believe we're heading into a recession. Well, they increased the dividend in the last recessionary period, 07-09. Now, whilst we see a negative 6.5% for recession sales, this was above the average growth during the 07-09 period, which was in fact negative. And again, whilst they did have that total shareholder return of negative 26% for the 07-09 period, this was above the S&P's negative 55%. So positive if you believe we're heading into a recession. Now, the dividend. Now, what we can see straight away from here is they have actually had a very, very minimal growth dividend over the period. They haven't increased the dividend since 2020. The compounded annual growth over the last 5 years was 1%, and the compounded annual growth over the last 20 years was 4%. As I always say, year on year, you do want a minimum of 4% in your other income producing assets, your dividends and salaries, as you are taking a pay cut or losing your purchasing power. If not, as the US inflation rate over the last 40 years was 4%. So just one thing to be wary of and one red flag indicator I would say so far. But again, we should be looking towards forward guidance to see what is expected. Now, in terms of the dividend yield theory, well, it states a company is undervalued when the current yield sits above the 5-year average. What do we see here? Well, 3.6% versus 3.1%, so one sign of undervaluation right now. However, as always, we never look at any model in isolation and we'll draw a conclusion towards the end of the episode. Likewise, forward PE 13.4 versus the 5-year average of 16.5, another sign of undervaluation. Likewise, the sector PE significantly higher than the PE for Campbell Soup at 13.4. As I did mention at the beginning, it is towards the 52-week low. However, 52-week low does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Now, free cash flow or earnings, well, if you're a regular viewer of the episodes, you know we only look at the free cash flow. Earnings is susceptible to manipulation by management through accounting. What do I personally look for? Well, I look for around 60% below. Why? Because to me, that signals there's room for the company to increase that dividend to double digits that we love to see as dividend growth investors. Now, below 60%, other than 2014, we can see they've consistently had a below 60% payout ratio for the free cash flow metric. So very, very positive in my personal opinion. Gives me faith in that dividend safety score. Now, if we move on to the free cash flow per share, again, I don't tend to look at the earnings per share, but it is available there for investors. 176 in 2014, 259 in 2023. So it is upward trending. Granted, we do see periods where it does go up and come down, so it is fairly cyclical. But it's positive to note 2024, it is expected to go up to $3.20, so an increase from 2023. Now, sales growth, as I mentioned, whilst we look for 3 to 7% as a minimum, as a threshold for growth, we can see it has been a very different story for Campbell Soup, with some cyclicality being shown. A year here of positive increase in sales, a few years of negative, positive, and then negative as we see. So numerically, we can see 8.3 billion reported sales in 2014, 9.4 billion in 2023. So there isn't a large amount of growth over the last 10 years to that top line. Another red flag indicator in my opinion, so something to look into moving forwards. Shares outstanding. Obviously, we love it when companies do share buybacks, returning excess cash to our shareholders. But I would essentially say there hasn't been much real movement over the last 10 years. Yes, they do share buybacks, but very, very minimal to really warrant anything to explain. ROIC, one of my 7 golden dividend metrics. If you want to see the other 6, do check the pinned YouTube video. 10% plus is what I like to see. Why? Because it gives me faith in management and their ability to effectively allocate their capital. So with this respect, I think they have done fairly well. It has been above the 10%, with the last few years around 13 to 17%. Now, in terms of margins, again, this is somewhere that consumer staples as a whole do struggle, but 16% plus is what I like to see. The fact that they have been around that over the last 10 years, for me, whilst I would like to see above 16%, around the 14 to 15% would be acceptable for me, as we can see. Likewise, free cash flow margin, they have been able to consistently get around 7% plus, so that is a fairly positive for me in terms of this company. Now, net debt to earnings for interest, tax, depreciation, amortization, we've said here a minimum or a maximum in effect of 4 years for the company to pay off all their debt net of cash on hand. What can we see? There were 2 years where it was well above our threshold, but since that point they have come down quite consistently, with 2024 expected to be even lower, as we saw they are paying off that debt, which is a very big positive and plus for me personally for this company. Here we can just see that 2023, 55% of the company's financing was from debt as opposed to equity. Now we jump into the stock valuation model. For those that have been enjoying the content, value is being provided. Do smash that like button. Do join the community for these regular stock video analysis. And if you do want to run your own company through this model, do click on the comments below and grab a copy to run your own companies to see what their intrinsic value would be. Now we jump into Graham's valuation model. We have the stock ticker with the earnings per share, growth rate per analyst estimates with that current yield on AAA corporate bonds, giving an intrinsic value of $30.40. So based on Graham's valuation, there is overvaluation to the current trading price. and shows signs that it should be further lower than that 52-week low we see. Now, in terms of the multiples valuation model, we have companies in a similar sector and size. We have Kellogg's, General Mills, Hormel Foods, and Kraft Heinz. Based on their stock price and earnings per share, we get their PE multiples. We multiply the average by the earnings per share of CPB, and we get a stock price based on the multiples valuation model of $53.56, just lower than that 52-week high, showing real signs of undervaluation and significant room for growth for the Campbell Soup company. Then moving on to the dividend discount model, as mentioned earlier, their dividend increases haven't been the greatest over the last 5 years, average around 1.14%. Now, forward looking, I have gone for maybe a fairly more optimistic 3%. However, you could justify lower. If you did want to justify higher, again, that is completely up to you. And if you want to run through your own numbers, again, pick up a copy of the model below and run your own company numbers through. However, based on these estimates and judgments, it gives us a DDM price of $30.49. Again, still showing signs of overvaluation to the current trading price. We then move on to the final model, the discounted cash flow model, with our free cash flows year on year. Average growth rate coming around 6.4%. Forward-looking analysts are expecting a slightly lower growth rate at 5%. Coupled with our discount rate, we get the present value of future free cash flows and terminal value. Add that together with the cash, subtract the total debt, we arrive at our equity value. Divide that by the shares outstanding gives a DCF price of $56. Right there at the 52-week high, again showing signs of significant undervaluation and room for growth. As always, if you are enjoying the content, do hit that like button and do subscribe to join this wonderful community for those stock video reviews. Now, the intrinsic value is essentially the average of the four models that we have just run through, coming in around $42.62, roughly there at the current trading price, showing a fair valuation for the company. Now, in terms of the essential margin of safety, typically I would say 10% for a wide moat company, strong financial metrics, good forward-looking data. For those that believe that to be the case for this company, your acceptable buy price would be around $38. Now, personally, if I was to invest in this company, I would say anywhere between 15 to 20%. It does look strong forward-looking, where they are paying down their total debt. So for me, that isn't a real issue. But one thing I would like to see is those increases in those dividends. So 15% margin of safety would be a buy around $36, with 20% around $34. So in my personal opinion, this would be a buy around $34 to $36. Now, Wall Street forecasting the price to go around to $47 over the next 12 months, showing some signs of upside around 15 to 20%. As always, let me know your thoughts in the comments. Are you a shareholder? Are you looking to buy or even looking to sell? Even if you're purely on the sideline speculating. As always, don't forget to like, subscribe, catch you on the next episode. Take care and have a wonderful day.